Welcome back to Clear Path Retirement Radio. I am Stuart Smith here with Mitch Davies, and now we're going to have my favorite part of the show, which is Mitch's Market Minute. Mitch, take it away.
Thank you, Stuart. I'm excited. Yes, as always, we're going to jump into it with the same structure we've been following. We're first going to look at where we're at today, where the markets are at overall. Second, we'll look at where we're at for the year, what's been doing well, what's been lagging behind. And then third, we're always going to try to talk about current trend, right? What we're watching at the firm, what we're trying to be ahead of. We're always trying to be a step ahead of the market, right? We're always trying to be a step ahead of things. So to look at first where we're at right now, we just had the Dow break through 50,000 for the first time. It was the fastest 10-point advance we've ever seen in history. So exciting stuff there. Last week, we celebrated the S&P breaking 7,000. It since came back a little bit. Nasdaq right around 23,000. As far as the year goes for the three major indices, not too much progress. We've been bouncing back and forth. We've had the Dow and S&P push up, but overall not too much. What's been really leading the way, and this will set up our discussion for later, is energy and consumer staples and that kind of thing. The index that tracks this bucket of stocks, we're using the consumer staples sector ETF. It's up 13% this year. So really quite interesting. And that's one thing that's the big theme right now is the AI bubble, right? We talked about it last week, but it's what everyone's thinking about. It's what everyone's talking about is the mega cap tech driving force that we've had. And what can we be doing to maybe shift gears from that? These companies are earning good money, they're performing well, so we don't want to not have exposure because over the last 5 years, these companies have driven a lot of returns. They've done really well for people. So we don't want to shift out of that and just get rid of all AI tech companies because they've done well, and we feel that they will still do well. But would it be a good idea to start looking at, okay, if we all agree that these tech companies are super highly valued, right? Their valuations are high. We're seeing multiple companies in the $1 trillion range, which most of this is just from stock price, right? NVIDIA, the biggest company in the world, a lot of this valuation is from insane stock purchases. So that being said, if we're worried about inflation, we're worried about the dollar declining, we're worried about these things, what if we start shifting a little bit into these consumer staples, consumer defensive sectors? And what I mean by that is the companies that are recession-proof. Like, they're going to hold through any market cycles. We look at the big names like Procter Gamble, you think of Dollar General, Waste Management, Walmart, the companies that when discretionary spending is down, still perform quite well, still are going to have people coming in every day. People have to go buy these things. People have to grocery shop. People have to take out the trash. People have to buy toilet paper, toothpaste, these types of things. So if we are worried that the dollar's declining, we're losing purchasing power, why don't we start shifting a little bit of our portfolio into some of these sectors? This is something we're being extremely proactive with right now, and we're excited about. We think it's a good pivot for the year. We look at, again, these types of companies. If we look at 2008, we look at 2022, the last two big equity drawdowns that we've had, these companies have held up extremely well. If we look at 2022, for example, the overall equity market, the big ETFs were down 17, 18%. And this consumer staple ETF was only down 3%. While it still was down, it held up much better. And we've actually seen some instances where some of these companies were up during these times. So something we wanted to put on your radar was, hey, if we're worried about being overexposed to tech, being overexposed to just S&P and Nasdaq funds, what if we start taking a little bit and focusing on what is always going to be around? What do people always need? And this is what we, again, call the consumer defensive, consumer staple sectors of the market. And you've got the market split into 7 general sectors. So this is a shift that we're really focusing on for the year, something we're, again, always trying to be proactive, always trying to think about what's going to help us accomplish these bucket strategies, to help us protect against different market cycles. And this is a shift we're going to talk more about as the year progresses, but definitely wanted to just address this for you guys. And if you are in retirement and you're trying to navigate through these things, it can be challenging. It's important to have a team that's looking at this stuff and trying to be ahead of it because we eat, breathe, sleep this stuff, right? This is what we do every day. So it's really important to have a team working behind the scenes for you. And yeah, that's the Market Minute for the week. A bunch of exciting stuff, and we'll continue the conversation, Stuart.
Yeah, fantastic stuff. So we've been having a lot of these conversations in the office. Those are the companies that have pricing power to have the ability to kind of outprice inflation as well, and really do well in inflationary environments where we may be headed, as a matter of fact. Mitch does a really good market update for all of our investment clients, and if you are interested in receiving that, then shoot him a quick email. It's mitch@clearpathretirement.com, mitch@clearpathretirement.com, and he'd be happy to add you to list for that. If that's something you're interested in getting, he puts it out pretty much weekly, and it is excellent information. So yeah, definitely take advantage of that if that's something you're interested in. It's more focused on retirement investing. There's a lot of good investment information out there, but most of it, I feel like, is more geared towards people who are in the accumulation phase.
It is.
I like what we do because it's really talks more about the philosophy and how, what we're doing for people who are retired, which is absolutely a completely different mindset when it comes to investing.